There is a particular kind of silence that falls over a trading floor in the 90 seconds after a jobs report drops. Not the silence of calm, but the silence of several thousand people doing arithmetic in their heads at once. That silence just happened. And if you own silver or you have been circling it for months waiting for a reason to jump in, what occurred in that silence is the reason you have been waiting for. Let me be plain about what I am not going to do. I am not going to hand you a headline and a hot take and send you on your way, the way most of what passes for financial commentary does these days. That approach is beneath the subject and, frankly, beneath you. What I am going to do is walk you through this methodically, the way you would want a trusted, slightly skeptical friend to walk you through it, so that by the end you understand this market better than the people shouting about it on television. Before we go further, I want to know something. After watching this jobs number land, are you feeling more optimistic about silver or less? Just one word in the comments. More or less. I read every one of them, and I mean that literally, not as a courtesy. Now here's the thing almost nobody explains properly. A jobs report does not move silver directly. It moves silver through a chain of reasoning, and once you understand that chain, you will understand every flinch in the price today and for the rest of this year. The chain works like this. A jobs report tells the Federal Reserve how hot the economy is running. A hot economy gives the Fed license to keep interest rates elevated, because that's the tool it uses to lean against inflation. High rates are silver's natural enemy, because silver pays no dividend, no coupon, no yield of any kind. It just sits there, gleaming and inert, while cash in the bank earns you something for doing nothing. A soft jobs number does the opposite. It hands the Fed room to ease, and easing is oxygen for a metal like silver. So burn this into memory. Silver is not reacting to jobs. It is reacting to what jobs imply about the Fed's next move. That is the entire mechanism. The metal has been a hostage to interest rate expectations for months now, and that is exactly why the chain matters more than the number itself, because the chain, the very thing that has kept silver pinned down, may be starting to fracture. The first crack did not appear this morning. It appeared 2 days ago, and almost nobody connected the dots. Rewind to Wednesday. The new Federal Reserve Chairman, Kevin Warsh, stood on a stage in Portugal and said something that quietly undercut his own reputation. For months, markets have treated Warsh as an unshakable hawk, the man installed specifically to keep rates high and keep silver buried under them. But on that stage, Warsh conceded that inflation expectations had eased over the preceding month and signaled there was no particular urgency to push rates any higher. That is not the language of a man spoiling for a fight with the economy. That was crack number one. Watch what happened next, because it proves the point rather than merely asserting it. That same day, silver did not fall. It jumped 3% back above $60, rebounding sharply off its lowest point in 7 months. The chairman spoke, the hawkishness softened by a hair, and silver leapt like a man who'd been holding his breath. Then, also on Wednesday, private payroll data came in softer than expected. The first real hint that a red-hot labor market might finally be cooling its heels. 2 cracks, in 2 days, in the exact narrative that has been sitting on silver's chest. By the time today's jobs report arrived, the ground beneath it had already shifted. So the question worth asking is not simply, what was the number? It is the thing that has been crushing silver actually beginning to give way? Because if it is, the move ahead could be considerably larger than anyone watching the daily ticker expects. And to understand why that possibility deserves to be taken seriously, you need to understand a mistake the market has made once before, and gotten spectacularly wrong. Here is where this gets genuinely interesting, because the market has run this exact play once already, with a brand new Fed chairman, and been proven wrong within about a year. Cast your mind back to 2018. A new chairman took the reins, Jerome Powell, and Wall Street wasted no time branding him a hawk. He hiked rates 4 times that year, including a December move that triggered one of the sharpest sell-offs of the decade. The financial press reached for exactly the language you're hearing about Warsh today. A tough new sheriff, unbothered by a little market bleeding. By early 2019, that verdict had calcified into conventional wisdom. Powell, the permanent hawk, case closed. Then the data changed. And so, notably, did Powell. Through the back half of 2019, the very man everyone had crowned a permanent hawk reversed course hard, cutting rates 3 times and undoing most of that year's tightening within roughly 12 months. Here is why that history matters for the silver in your hand or your portfolio right now. Through the hawkish stretch, gold and silver drifted lower, ground down by the same rising rate, strong dollar current that batters metals every time. But the moment Powell pivoted toward cuts, both rallied hard. And the people who panic sold near the bottom of that hawkish scare, convinced the bull run was finished because a stern new chairman had arrived, missed a recovery that arrived within the year. That is the pattern hiding beneath today's panic. The market has crowned a new chairman a permanent hawk before. It got frightened. It sold. And it was wrong. Research out of Citi even explains the mechanism. New Fed chairs deliberately sound tough in their early appearances to establish credibility, regardless of what they actually believe over the longer run. The market reacts to the novelty of the man, not necessarily the substance of his views, which means the hawkish fear currently sitting on silver could be built on precisely the same illusion that fooled everyone in 2018. But there is a bigger reason today does not settle anything, and it involves a man almost nobody covering this story has bothered to mention. Here is a fact that, as far as I can tell, has gone almost entirely unremarked upon, and it may be the single most consequential detail for where silver goes from here. When Warsh took over as chairman, the man he replaced did not pack up his office and vanish, as everyone assumes an outgoing chairman does. Jerome Powell stayed. This is the first time an outgoing Fed chair has remained on the Board of Governors since 1948. Here is how that's possible. The chairmanship is one job, but every chairman is also one of 7 governors, and that governor's seat runs on its own separate term, in Powell's case, all the way to January 2028. Which means Powell is still in the room, still at the table, still casting a vote on every decision that touches your silver holdings. Why does this matter so much? Because the entire bearish case for silver rests on the assumption that Warsh now single-handedly determines the metal's fate. But the Federal Reserve is not a monarchy. It is a committee, 12 voting members, and the chairman gets exactly 1 vote among them, the same as anyone else. To move policy in any direction, Warsh has to persuade a majority, and that room is not a blank slate built to his specifications. It contains independent voices with real votes, including the one man who lived through and ultimately reversed the permanent hawk narrative in 2018 and 2019. Here is the detail that flips the whole panic on its head. To make room for Warsh on the board, another governor had to step aside, Stephen Moran, who happened to be the most vocal advocate on the committee for cutting rates. So the committee did not simply turn more hawkish when Warsh arrived. It lost its loudest dove and gained a new chairman, while the rest of the room stayed largely intact. One analyst summarized it bluntly. Because Warsh has to win over this exact committee, he may end up one of the least powerful Fed chairs in recent memory. That is not a man who unilaterally decides silver's future. That is one vote in a genuinely divided room. Now before you go and I lose you, this is the point in the story where I have to ask something of you. Everything I've just laid out, the Powell parallel, the committee math, none of it is a guarantee, and I owe it to you to say so plainly, rather than let you assume more certainty than actually exists. But if this kind of unhurried, honest walk through the mechanics, rather than the panic and the headlines, is useful to you, that's precisely why this channel exists. Subscribing costs you nothing, and it means you won't miss the next piece of this story as it develops, because I promise you, it is going to keep developing. If you've gotten this far and found it worth your time, that's the moment to hit subscribe. Now let me be fair to the other side because I promised you honesty rather than comfort, and a one-sided argument is just propaganda with better manners. The 2018 parallel is compelling, but it is not destiny, and there are real differences today worth taking seriously. The biggest one, in 2018, inflation sat close to the Fed's 2% target, which is a large part of why Powell found it so easy to pivot. Today, inflation runs hotter. Core readings have hovered around 3%, still above target. And there has been a fresh energy shock stemming from conflict in the Middle East, adding further pressure. On top of that, the labor market has been genuinely resilient, with recent reports repeatedly beating expectations, giving the Fed real cover to stay tight for longer. That is substantive. It means the case for Warsh actually following through on a firmer path this time carries real weight, not just noise. So here is what is genuinely true on the bearish side. Markets are still pricing in a better than 60% chance of a rate hike by September. If today's jobs figure ran hot, that pressure only intensifies, and silver could well move lower before it moves higher. Silver's dual nature, part monetary asset, part industrial commodity, means it absorbs both interest rate fear and growth fear simultaneously, which is exactly why it has fallen harder than gold on the way down. If the hawkish path holds, silver stays under pressure. I am not going to pretend that risk isn't real, because it plainly is. But here is the honest synthesis, and it is the whole point of walking through all of this. Nothing here is settled in either direction. The market keeps treating each individual moment, a Warsh speech, a single jobs report, as a final verdict. It is not. It is one data point in a long, messy process being decided by a divided room, with a genuine counterweight sitting at that table over months of data still to come. The gap between the certainty the market is currently pricing in and the actual uncertainty that exists underneath it, that gap is the single most important thing for you to understand right now, more important than today's number itself. And here is why that gap matters more than people realize. Certainty is what makes people sell at the bottom. Think about the mechanics of it. When a market becomes convinced that silver is finished, permanent hawk, rates high forever, story over, that manufactured certainty is precisely what triggers the final wave of panic selling. People give up. They dump their holdings at the lows, telling themselves they are cutting losses like responsible adults, and that moment, almost without exception, is exactly when the more patient, better-informed money begins buying. Because the people who understand the chain we just walked through, who know a new chairman's tone is not destiny, who know Powell is still in the room, who know the committee is divided rather than unanimous, they see manufactured certainty as opportunity. They buy what the panic is selling. This is not a theory I am asking you to take on faith. It is what happened in 2018. It is what happens near the bottom of nearly every fear-driven sell-off in history. The crowd sells certainty, the patient accumulate uncertainty, and right now, whatever today's number actually said, the underlying picture has not changed. What is crushing silver is a temporary, rate-driven fear, not a collapse in the value of silver itself. Because here is what today's jobs report, hot or cold, did not touch. And it is the foundation everything else sits on. Here is what no jobs report, hot, cold, or anything in between, changed this morning. And it is the ground everything else stands on. The world has now consumed more silver than it has mined for 6 consecutive years. 6 straight years of deficit. Today's jobs figure did not put a single ounce back into the ground. The demand driving that deficit, solar panels, electric vehicles, semiconductors, the build-out of AI data centers, did not pause for an economic release. Roughly 70% of all silver is produced as a byproduct of mining other metals, which means miners cannot simply ramp up output because a number crossed a screen this morning. The physical supply chain does not work that way, and it never has. And then there are the central banks, which is the detail that tends to stun people when they hear it for the first time. Central banks have been accumulating gold at a record pace, with recent surveys showing an overwhelming majority planning to keep increasing their reserves, quietly rotating out of dollars and into hard metal, entirely indifferent to whatever headline dominated the news cycle this morning. So step back and look at the whole board, not just the square you're standing on. On one side sits a temporary rate-driven fear tied to one chairman's tone and 1 month's data. The exact kind of thing history shows the market routinely gets wrong. On the other side sits a 6-year physical shortage, industrial demand that shows no sign of slowing, supply that structurally cannot respond quickly, and some of the most powerful financial institutions on earth buying the physical metal with both hands. The paper price bounces around on jobs numbers and Fed speeches, sometimes violently. The physical reality just grinds on underneath it, quietly getting tighter every single year. That disconnect, the panicking paper price against the relentless physical truth, is the real story that today's number is distracting almost everyone from noticing. Now let me show you the one moment in history where this exact configuration existed before, because it is instructive in both directions. Go back to 1979 and 1980. The ingredients then? Turmoil in the Middle East, an oil shock, inflation running hot, and a Federal Reserve forced to respond under enormous pressure. It is an eerie echo of the present. War, energy pressure, sticky inflation, a Fed under the spotlight. What did silver do? First, something almost unimaginable. Driven by inflation fear, it ran from a few dollars an ounce to nearly $50, one of the most explosive bull runs in the history of any asset class. War, energy shocks, and inflation fear can be pure rocket fuel for silver. That is the half of the story nobody wants you to forget. But then came the second half, when the Fed, under Paul Volcker, crushed inflation by pushing interest rates to brutal, almost punishing highs. Silver collapsed right back down. The same institution that let inflation run also held the power to end silver's run, simply by making cash and bonds irresistible again by comparison. So what does 1980 teach a silver holder today? Precisely the lesson this entire script has been building toward. War and inflation fear can drive silver violently upward, but the Fed's response is the ultimate arbiter of where it ends. The same crosscurrents 45 years apart, decided by the same institution holding the deciding card. History does not repeat itself exactly, and I will not promise you that it will, but it demonstrates that both the explosive upside and the genuine risk in silver right now are real, which is exactly why what you do next actually matters. So here is something practical, because the Fed is going to keep throwing moments like today at you. More speeches, more data releases, more frightening headlines, and I do not want any of them shaking you loose the way today's did for so many people watching. First, Watch the votes, not the tone. Warsh has deliberately kept his language vague and stopped offering clear forward guidance, so stop trying to read his mood from a single speech. Watch what the committee actually does at each meeting. The vote is the fact. The tone is noise, engineered to keep you guessing. Second, watch the data the Fed cannot spin: jobs and inflation. Warsh can talk in circles all he likes, but he cannot argue with the actual numbers, which is exactly why today mattered, and why every jobs and inflation report from here forward will matter more than any speech. Watch in particular whether this energy-driven inflation fades like a one-time shock or spreads into something broader and stickier. If it fades, the hawkish case weakens with it. Third, watch for the pivot signal. If, over the coming months, the Fed's own projections begin drifting back toward cuts rather than hikes, that is the clearest possible sign that the 2018 pattern is repeating in real time, with the one man who lived through it the first time sitting right there to recognize it happening again. And fourth, remember that volatility itself is the trap. An unpredictable Fed produces sharp, frightening swings in silver in both directions, and most of those swings mean nothing in the end. The holders who get hurt are the ones who react to every lurch, including today's. The ones who do well watch the votes, the data, and the trend, and they tune out the rest. So here is what I want to leave you with. The people who lose the most in a moment like this morning are rarely foolish people. They simply watched a number flash across a screen, felt the price lurch beneath their feet, and let that single moment convince them the whole story had already been written. They mistook a data point for a verdict, and on the other side of their panic sale, almost always, is someone who remembered 2018, who knew Powell was still in the room, who understood that today was one test in a long process rather than the final exam, and who stayed calm while everyone else flinched. I did not put this together to tell you silver is guaranteed to soar. It isn't, and I have tried to be straight with you about every real risk along the way. Nor did I put it together to tell you what to do with your money. That decision is yours, and only yours. I put it together because you deserve the whole board. What today's number actually means. Why one moment is not a verdict. The mistake the market keeps repeating. The man still sitting in the room, and the physical truth that no jobs report can touch. So here is my real question for you, and I genuinely want to know the answer. After today, do you think this is the moment silver's slide finally turns? Or do you think there is more pain still ahead? Tell me which, and tell me why in the comments below. The discussion down there is sharper than most of what passes for analysis on mainstream finance television, and I read every single one of them. And remember, this is for education and discussion only, not personal financial advice.